When you invest in something, you expect return. For example, when you invest in real estate, you expect a monthly rental income. So, how do we get rental income from stock market? Hi, I am Vinayak from NiftyNayak.com. Please follow me and subscribe to our channel to learn more about trading and investment. The strategy which I am going to teach you today is called the covered call strategy. I have a small disclaimer. This video is for educational purpose only. Please consult the right financial advisor before you take any trades. So let's see how we do the covered call strategy. For example, you want to invest in Reliance shares because you believe in the Reliance geo growth story. But when you invest in Reliance, the return which you get is only the dividend. You get appreciation gain if you sell Reliance share. Otherwise, it is just the notional value. The strategy which I explain here is a low risk and can be easily deployed. Reliance has a lot size of 500. So we buy 500 shares of Reliance by investing 7 lakh as Reliance is trading at 1400. Now every month we determine an OTM call strike which Reliance may not touch in that month. You can use your technical skills, OI analysis skills, fundamental skills, or whatever skills to determine that. Now we analyze and determine that Reliance may not touch 1700. So we sell the 1700 call, let's say for 20 rupees. If Reliance does not go to 1700, then congrats, you have made 10,000 in that month. Now you might feel that you should bring in another lakh for doing this trade. But that is not the case, and that is the secret. You can pledge your Reliance shares to the exchange to get the margin. Reliance has a haircut of 20%. You can check the haircut of individual shares in NSE website. So this means that you can trade for 80% of 7 lakh, which is 5 lakh 60,000. So every month you do this for the stocks in your portfolio and you get an additional money on top of your dividend. Now, what if your analysis was wrong and Reliance shot up suddenly to 1700? There's no need to worry. There are many adjustment options which we have. Let me explain some of them here. You can give delivery of the stocks which you have. Since we have the underlying stocks, you can allow the contract to expire and the stocks will be debited from your account. It's like selling Reliance stock at 1700. As it was bought at a much lower price, you will be exiting Reliance in profit. If you are not interested in selling the stocks, then you can do the martingale strategy. Let's see what that is. Now, if your 700 call is in profit, then close the call option and sell another option of a different strike. If your 1700 call is in loss, then close the option and sell double the quantity of another strike, call strike. The strike which you select should be such that the premium should negate the losses which you made in your previous trade. Let's say initially you sold 1700 at 10 rupees, Reliance shot up, and your 1700 call is now at 30 rupees. You are currently sitting with a loss of 20 rupees in this trade. You close the trade, take the loss, and you sell another call whose premium is 30. But this time the quantity will be double. Let's say 1900 has a premium of 30. You sell that and now you are safe till 1900 is reached.